Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a look at a couple of trade ideas that I'm monitoring at the moment. Let's jump straight into the charts. I've got the S&P 500 here, or at least a CFD that tracks the price of the S&P 500. And you can see this morning we've just crept back above 3,800. We're just back above that 50-day moving average once again, as US markets await. Well, actually, voting in the US for the midterm elections has actually begun. All of the House of Representatives seats are up for grabs, and a third, or I think it's 35 of the 100 seats in the Senate are up for grabs. And pretty much what markets are expecting is that the Republicans are going to win a majority in the House, and they could actually flip the Senate as well. But to be honest, as long as they secure that majority in the House, that's what matters. Because if they get their majority in the House, then they can effectively block all of the Biden administration and all of the Democrats' legislative agenda. And it seems that markets are viewing this likely outcome as bullish because pretty much if you don't have any more big fiscal stimulus or big fiscal spending from the Democrats, then that reduces inflationary pressures in the US economy potentially, which reduces pressure on the Fed to be quite as hawkish. And also, a divided Congress has historically been seen, or stock markets have historically done well when Congress has been divided. And midterm elections, which usually result in a divided Congress, have historically been a good buying opportunity going back. I think the last like 20 times, a couple of the banks that I read their research, they were talking like going back like the last 19 times, every midterm election saw stocks higher 1 year later. So, yeah, the point of all this is I'm saying I think we could potentially see a bit more of a rally. We could potentially go back to 3,900 and test some of these recent highs. We've got US inflation data coming out later this week. That's always a bit of a coin toss, but if that was to come in as expected or perhaps a little bit lower, then you could potentially even be talking about a slight break above these levels here. Because softer than expected inflation, a divided Congress would potentially support the argument for the Fed to slow down the pace of rate hikes in the coming months. Last week, you had Fed members talking about how they would open to a slowing of the pace of rate hikes. Markets are currently, in fact, let's actually have a look. Fed CME tool. Let's look at what markets are pricing for the next rate hike. Yeah, they're pretty much 50-50 on whether it's going to be a 50 basis point hike or a 75 basis point hike. Well, if that starts to swing more in favor of a 50 basis point rate hike, then, that could be supportive of sentiment. And I'm thinking we could potentially see a rally all the way back to 4,000 or above 4,000 even, towards this 200-day moving average there, which is just below 4,100, potentially back to this downtrend. Now, when we get to these kind of levels of around 4,100, that's when things start to get interesting for me, because potentially, and that's when you could potentially be looking at shorting once again, I would think, because yes, the Fed might be slowing down the pace of rate hikes, but we're still not sure where that terminal interest rate is going to be. And if you have one inflation reading that's softer than expected, that doesn't necessarily mean you can declare victory on the fact that inflation is going to swiftly come back to 2% because, these CPI readings, let's just look at what the market's expecting. We're still expecting it to be way, way above the Fed's target. Look, yeah, we're expecting a drop to 7.9% year over year from 8.2%. The Fed's inflation target is 2%. So, a softer than expected inflation reading doesn't necessarily mean that we're not going to have a terminal rate of 5.5%. And, if this discussion of the terminal rate, how high interest rates are lifted to next year continues to be quite high, then this bear market in equities, particularly as we have signs of the US economy slowing down, it might not be over just yet. So I'm looking for a rally back to this area And then once we get there, if we get there, I'm looking to reassess the fundamentals and potentially be looking to go short once again. If inflation is looking like it is decisively falling and the Fed's going to do a dovish pivot, then maybe it's time for the breakout and the test of the summer highs and a push back to record highs if we're going to get a big dovish Fed pivot. I don't see that just yet, though. I think it's too early for that. That's a story for 2023, not a story for Q4 2022, in my opinion. But anyway, that's stocks. Let's just look at one more thing that I'm looking at. It is to do with euro dollar, and it is predominantly a dollar sort of trade idea, you could say, that you can express through euro dollar. The first thing to say is we had this nice long downtrend that pretty much lasted the whole year that I was banging on about for weeks and, well, months actually, I think. And it was well respected for a very long time, but those days are now pretty much over. Um, we've broken above this downtrend, and it looks to me that we're in a bit of a short-term uptrend, if anything. All this talk about the Fed slowing down their pace of interest rate hikes, that's all helping lift euro dollar, and we're back at parity. And bear in mind, we're still not talking about the ECB slowing down their interest rate hikes. So even though the Eurozone economy is not faring particularly well and the US economy is still stronger, the policy divergence story in the short term could potentially support further upside for euro dollar. So I'm thinking potentially we could get back to this resistance in the 102 area. Depending on how things go this week, like if we get that divided Congress, which blocks further fiscal stimulus from the Democrats, that actually hampers the outlook for US growth, which would arguably be dollar negative. If you got the softer than expected CPI later this week, that would be dollar negative. If you get further dovish chatter from FOMC policymakers, like I was just saying about how they maybe could be thinking about slowing the pace of interest rate hikes, all these things could be going in towards lifting the dollar a little bit. And then you could potentially see, I think, the formation of a bit of an ascending triangle. Maybe we get some consolidation in the 101 to 102 area beneath this resistance. And then sometimes these patterns play out. Well, very frequently you see a bullish breakout of these ascending triangle patterns. So that's something I'm going to be watching out for. It's very early to be talking about this pattern because we haven't got there yet, but I'm going to be monitoring to see if that gets formed. And to see if we eventually break out above 102 to test this 103.50 resistance area. Well, it was support in early summer, and then it turned into resistance in later in the summer. But yeah, that's just another thing I'm looking at. But yeah, guys, I hope you enjoyed the video. I hope you all found it informative, and I will see you all in the next one.